movies.
Can we turn off the waiting room so everybody just automatically gets in? Can I do that real quick? Go ahead and get started. Hello, everybody. We're working on getting everybody in here, and we will start in just a second. Turn off the waiting room, so if anybody comes in late, they'll get in automatically. That should do it. Let me. All Oh, there we go. All right, guys, I'm going to start recording. Oh, it is recording. And I'll share my screen and we'll get going. All right. So today's goal is to get you guys ready on chapter 10 and 11 type stuff for the final exam. At the end, if you have questions on anything related to old stuff, feel free to ask that as well. But since the biggest portion of the final exam, no matter who your teacher is going to be chapters 10 and 11, want to make sure that we're in good shape on those things. So with that in mind, thinking about chapter 10. Chapter 10 was all things liabilities. And so when you think about liabilities, big things we talked about there were notes payable, deferred revenue, payroll, sales tax, and bonds. So the first problem on the review sheet here for chapter, 10, is thinking about interest on a note payable. The notes payable stuff is the same idea as the notes receivable stuff from chapter 8. So the process of calculating interest rates or interest payments is exactly the same as when you were trying to calculate interest revenue back in chapter 8. So looking at this particular one, we're talking about September 1st, a 6-month, 6% note. The biggest things to be able to do, and that's interesting, I didn't complete. Part C here, there's also a extra entry where we also have to record the note payable and the cash. Sorry to have shortcutted you there. But while I find a marker that works, you will think about those calculations, because the most important ones are going to be these interest calculations, because those are the ones that actually take some thought to be able to do. So we want to make sure we know how to get to those. So we need to remember that on a note payable or also on a note receivable. So if there's a note receivable question on the cumulative portion of the final exam, interest is exactly the same. We take the principal amount of the loan times our interest rate times our number of months out of 12. You want to remember that it's always out of 12 months, no matter what the term of the loan is, because interest rates are always quoted as annual rates. So like in this case, we know that at the end of the year, we do adjusting entries. Again, thinking about chapter 4, as we're kind of thinking from a cumulative perspective, when we looked at adjusting entries, remember the whole idea of an adjusting entry was we want to record any revenues or expenses that don't get recorded in the normal day-to-day transactions. So interest is one of those examples because interest is accruing on this note from the day that we take out the loan, even though we don't pay the cash for the interest until the note matures. So based on that idea of accrual accounting, we do a year-end adjusting entry to go ahead and record interest expense as well as our liability for interest payable on that loan. Because again, we've incurred the interest, but we haven't paid it yet. So we've got to record a liability for the interest payable. And then again, where we get to that, 80,000 times our 6% times 4 months out of 12 is our year-end adjustment. Because if we think about during this current year, we borrowed the money on September 1st. It's now September 31st, or sorry, so it's now December 31st, excuse me. So what's happened is September, October, November, December, 4 months have passed. So we've incurred 4 months of interest, even though we haven't paid for it yet. So we go ahead and record a $1,600 expense and a $1,600 liability for the interest payable. What's then going to happen is March 1st, or this could have been February 28th. Same difference, really, because if we think about what's happening in this second year, 2 months have passed from when we last recorded interest on December 31st through the 1st of March. Again, if it's the 1st of March, we're not going to include the month of March because it's only been January and February that have passed up to this point. When this 6 months is up, we have to make the payment on that loan. Your book uses 2 journal entries to record the payment on a note payable because it records the interest payment separate from the repayment of the principal. Well, what happens with the interest? Because again, the interest calculation is the one that's most important because it's the one that takes some thought and effort. Remember, last year we recorded this liability for interest payable. Now we're paying it back. So when we pay it off, we've got to debit that interest payable to remove it. But that was just for 4 months that happened last year. Remember, there's also 2 months of that loan that happened this year. So we need to record some additional interest expense for the 2 months that happened in the current year. Because when we think about the total cash payment for the interest, the total cash payment is for the whole 6 months worth or the whole $2,400. But because this loan crossed over between calendar years, the portion that happened in the first year was interest in the first year. Portion that's interest in the second year is an expense in the second year. But the total payment for the interest is that $2,400. So again, you want to make sure you can do the adjusting entry at the end of the year to accrue interest from when you loan the money through December 31st, as well as being able to do the entry to record the payment for the interest when the loan matures, where we're removing that payable and then recording any additional interest expense that's happened from December 31st through the maturity date of the loan. Questions at all about notes payable? All right, so another big calculation thing in chapter 10 was looking at payroll, because like we talked about in chapter 10, the way we've done payroll up until chapter 10 has been wrong because we just recorded everything in our credit to cash, whereas in real life, we've got to remember there's a difference between the total salaries expense a company records and the actual cash that shows up on the paychecks. Because from a person's paycheck, the company is required to withhold income taxes and FICA taxes. Again, in real life, there's other things they may withhold as well. For us, we go with the simple version where we just focus on the required taxes. But even then, we have to remember the salaries expense is the full amount of salaries and wages that employees have earned. But when we think about the net pay, what actually shows up on the paychecks to the employees, what shows up on the paycheck is the total salaries expense minus the things that the company has to withhold from the employee's checks. So remember, really, the employee is getting paid the whole $90,000. Just they don't get to keep all $90,000. Remember, this is multiple employees, but still thinking of it that way, because these taxes that are withheld are the things the employee is paying out of their paycheck that the company has to pay on their behalf. So those FICA taxes and income taxes that are withheld create liabilities for the company. Again, it's not the company's money. They're not saying, hey, we told you we pay you $90,000, but we're actually going to only pay you $68,915. No, paid you the whole thing. They just sent it to multiple different places instead of it all going straight to you. The net pay on your paycheck is the total salary minus those tax withholdings. We also have to remember, though, that in addition to the salaries expense, companies also have to pay payroll tax on top of that. Because this stuff up here in this first entry, these are things that were paid by the employee by having them taken out of their check. But in addition to the salaries expense portion, the employer also is responsible for FICA tax matching whatever was paid by the employee. Because remember, whatever it tells you the employee had withheld for FICA tax, the company is also going to have to match that every time. Because the FICA tax is actually 15.3%, and you don't have to know those percentages, but the way it works is 7.65% is paid by the employee. The other 7.65% is paid by the employer. So you've got to match the FICA and record all of the unemployment taxes. So a company's obligation for the payroll tax will always be matching the FICA and then also paying those unemployment taxes. So nothing super complicated, just knowing, again, who pays what taxes, how do we come up with the net pay that actually shows up on the paychecks. But it does create all these additional liabilities for the company that they are responsible for paying in addition to salaries. Questions on payroll? Okay. The other big calculation thing as we think about Chapter 10 related to bonds. And when it comes to bonds, you want to make sure from a conceptual standpoint that you understand why bonds would be issued at a discount or a premium. And it all relates to how the stated rate of interest on a company's bonds compared to the market rate. So for instance, in this example, we've got $3 million worth of 4.5% 10-year bonds. Well, if we look at the first scenario where it tells us those bonds sell at 96. Before we even look at the journal entry, I want to think about, we know that these are bonds issuing at a discount because they're issuing at less than 100% of their face value. So any bonds that sell at less than 100 are bonds issued at a discount. The reason bonds issue at a discount is because our bonds are paying a lower rate than the market rate. Okay, because again, here our bonds are paying 4.5%. Let's just assume that in this scenario, maybe it's because the market rate is, go with 5%. Okay? If our bonds are paying lower interest than everybody else, we have to discount our bonds
to get people to buy them. Because otherwise nobody would buy our 4.5% bonds when they can buy somebody else's that are paying higher interest. So when our bonds sell, for instance, here at 96, that means the cash we receive is not the whole $3 million. We're only going to actually get 96% of that because, again, we gave our bondholders a discount because they paid us in advance. Or not because they paid us in advance, because they paid us less to compensate for the lower interest. The difference between the face value of the bonds that we record as our bonds payable and the cash we receive, we record to this discount on bonds payable account. But again, thinking concepts, not just problems. Remember, the reason why that bond is going to sell at a discount is because the interest rate on the bonds is lower than the market rate. The opposite will be true anytime our bonds are selling at more than 100. If our bonds are selling for over 100, we call that a premium. Our bonds are going to sell at a premium price because our 4.5% in that case is more than the market rate. So again, we could assume, let's say 4% is the market rate. Our bonds are paying 4.5. If our bonds are paying higher interest than everybody else, we're going to be able to get more money than we thought for those because customers are going to pay a premium price to compensate the company for the fact that we're paying higher interest than everybody else. So in this case, the cash we receive is 102% of that face value. We're always just going to record the bonds at face value because that's what we have to pay back when they mature. And in this case, we're going to also credit a premium on bonds payable for the $60,000 difference. Again, thinking from a conceptual standpoint and some review type things. We remember back from the very beginning when we first started looking at journal entries. You've heard a million times by now. The total dollar value of your debits has to equal the total dollar value of your credits. So anytime you're doing a journal entry, again, fancy word we used back in chapter 2 is we use a double entry accounting system. Double entry means there's 2 entries for every transaction, or at least 2, because we know that every transaction has to have an equal dollar amount of debits as we have credits, which is how we're going to figure out that discount or premium in those situations to balance that out. Questions about that? One thing I want to add here as we're talking about bonds is just reminding you as well, when it comes to bond interest, I want you to remember that there is a difference between how we calculate interest expense on a bond versus the cash payment for the interest. Okay, when we're thinking about interest expense, the interest expense takes the carrying value of the bonds times the market rate of interest, whereas the cash payment for the interest based on the face value of the bonds times the stated rate of interest. Okay, because thinking back, remember that carrying value is the bond payable minus the discount, or the bond payable plus the premium. Every time we make an interest payment, that carrying value changes. So every year when we are making the calculation for interest expense, we have to recalculate it. Whereas the cash payment for the interest, I can remember that is going to be the same every year because the cash payment for the interest is based on what's printed on the bonds. And what's printed on the bonds is their face value and the stated rate of interest they're going to pay every year. So again, thinking about types of things you want to make sure you know how to calculate. You want to know the difference between the interest expense and the cash payment for the interest as well. Okay, a couple of chapter 10 things that weren't included on these sheets here, but are also things you want to remember are things like deferred revenue. Okay, you want to remember that deferred revenue is the liability that's created whenever your customer pays you in advance. So if you receive a payment in advance before you have actually provided a product or service to your customer, remember that creates a liability called deferred revenue. Then when you do the work, that's when you remove the liability and record the actual service revenue when that's done. Again, that was review also from chapter 3 and 4. We had already done that, but again, it fit in that liability chapter as well, remembering deferred revenue and how that works. We also talked about sales tax, just remembering that when a company collects sales tax, kind of similar to what I just said over here, when we are withholding these taxes from our employees' check for their income taxes, it's not the company's money. It creates a liability. Same thing if you sell products where you're required to collect sales tax. When you collect sales tax, that's not your money either. Sales tax also creates a current liability. So you want to make sure that when you collect sales tax, that you record that as a liability, not as part of your revenue. Okay, so it's not your money to keep. At the end of every month, you have to pay that back. So chapter 10 said notes payable, deferred revenue, sales tax, payroll, bonds. So quite a few different things that you wanted to be able to do in that chapter. Again, these are fairly comprehensive looks at the problem type things from chapter 10. We move on though and kind of think toward, let's see if I can get that all to show up on one screen. Kind of close. Well, I'll move it down as I need to talk about the part at the bottom. But as we kind of shift into chapter 11, chapter 11 is where we covered stockholders' equity. Always want to remind everybody, don't just focus on the problems for any job, okay? Problems are what we spend a lot of time on because they're what take the most work, but the concepts are equally important. So when you think about chapter 11, before we even start looking at problems, I want to remind you, again, conceptual type things that you looked at in chapter 11, just off the top of my head. We did things like, we talked about the advantage of being a corporation. We talked about the rights of stockholders. We talked about definitions of authorized, issued, outstanding, treasury shares of stock. We talked about advantages of debt or equity financing. We talked about definitions of preferred stock, what makes it preferred over common stock. We talked about treasury stock being a contra equity account. We talked about stock splits. Again, so I just rattled off quite a few things that are not problem-based. So you may not necessarily see it in a Connect assignment or things like that, but there are things that we talked about in detail in class. Remember, you want to make sure and go back and review those things as well, which seems like a good point for me to plug the study topics provided by your teacher, whoever that may be. The study topics are going to narrow down for you the specific concept and problem type things you want to remember how to do. Because as you think about the cumulative portion of the final, so the chapters 1 through 9 stuff, you don't have to remember every single thing you've learned all semester long. So make sure you use those final exam study topics to narrow down the parts of the old chapters that you spend your time studying on. But with that in mind, when we think about the problem type stuff from chapter 11, this first problem, so number 4 here, really looks at the journal entry type things that you'll need to remember how to do. You'll need to be able to issue stock, whether it be common stock or preferred stock. You'll need to be able to repurchase treasury shares. You'll need to know the journal entry to declare a cash dividend. So, this is pretty comprehensive thinking about the journal entry type stuff from chapter 11. So first thing, if we think about this company, they've got $1 par value common stock. And the first thing they do is issue 700,000 shares of that for $7 per share. You want to remember that when you issue stock, obviously the cash you receive is for the whole amount. We issued 700,000 shares at $7 each. We got $4.9 million. But we can only credit the common stock account for the total par value of the shares that we issued. So if we've only got a $1 par value, we can only credit common stock for $700,000. The rest goes to our new equity account called additional paid-in capital. Okay. And again, where we get that number, we know the cash, that minus the par value will get us to that additional paid-in capital because we know our total dollar value of our debits has to equal the total dollar value of our credits. Talked about that. Sometimes a company may decide to repurchase shares of their own stock. When a company buys back their own stock, we call that treasury stock. Again, thinking about a concept type thing. We talked about with treasury stock that there are some basic reasons why companies would do that. One, they want to just send a signal to investors that, hey, we think this is a good investment, okay? We said you might buy back your own shares if you have employees exercising their stock options. So you need stock available to sell to your employees. If you're buying another company and part of your purchase deal is that you're paying for that company with shares of stock, you may repurchase shares of stock. And then the fourth one is that you want to decrease the number of shares in the market. Okay, if we want to take shares out of the market to reduce the supply, increase the demand. Okay, so if we're trying to boost the company's stock price, one way we may do that is by repurchasing shares of that stock. So we decrease the number of shares that are outstanding so that, yeah, that lower supply can help drive up demand. But when we decide to do that for whatever reason, when we buy back shares of our stock, that creates treasury stock. Treasury stock is a contra equity account. So treasury stock will decrease our total equity. Okay, so we record that with a debit. So we debit treasury stock for the total value of what we got. We credit our cash because obviously when we're buying anything, but particularly here as we're buying our own company stock, we're paying cash. So we decrease our cash with a credit. Okay. Then when we think about dividends, remember those different dividend dates. We said the declaration date is the date when we announce the dividend. That's when we have a legal obligation to pay the dividend. So on the declaration date, we go ahead and record the dividend and a liability for dividends payable. because on that declaration date, we now have to pay the dividend. So we go ahead and record it plus the dividends payable. An important thing to note about dividends though is remembering that we only pay dividends on outstanding shares of stock. So in this case, to come up with the dividend, told us it was 75 cents a share. Well, we're going to pay 75 cents a share here on 680,000 shares of stock because remember, issued shares represent any shares that have been sold. Once you've sold a share of stock, it will always be considered an issued share. But a share is only outstanding if it's still held by investors. So anytime a company has bought back some of their own stock, the treasury shares reduce the number of shares that are outstanding. Because in this case, remember, we started by issuing 700,000 shares of stock. But if we then bought back 20,000 shares, in this case, there's only 680,000 shares outstanding. And we only pay dividends on outstanding shares of stock. Because if we pay dividends on all 700,000 shares, part of that dividend we'd be paying to ourselves. Because remember, the company now owns those treasury shares. Doesn't make any sense for us to pay a dividend to ourselves. So you want to make sure you remember, you only pay dividends on outstanding shares of stock. Any questions on any of the journal entries? Okay, so from a journal entry perspective, that's really the gist of it. Like I said, don't forget concepts. There's all sorts of concept questions from chapter 11. But in addition to being able to do those journal entries, one other problem type thing you want to be able to do is know how to handle dividends when a company has both common stock and preferred stock. Because remember, preferred stock has preference in the payment of dividends, amongst other things, and preferred stock gets paid at a set rate. So common stock, you don't know year to year what your dividend is going to be, but preferred stock you do, because you're told when you buy preferred stock what that dividend rate is, which is the percentage of the par value that you're going to get paid every year in a dividend. And in this case, this preferred stock has $100 par, and we have 10,000 shares outstanding. Because again, outstanding shares are what matter when it comes to paying dividends. So when we look at preferred stock, that means every year, the first $40,000 in dividends is being paid to the preferred stockholders. Okay, because they get 4% of that $100 par is the per share dividend times the number of shares outstanding. So anytime a dividend gets paid, the first 40,000 goes to preferred stockholders. We also need to remember, though, that if that preferred stock is cumulative, that cumulative preferred stock also gets paid dividends in arrears. Dividends in arrears is just our fancy term for missed dividends. So for instance, in this case, it tells us that dividends were not declared in 2023 and are in arrears, but that in 2024, the board declared a $280,000 dividend. Okay. That $280,000. Again, if there's preferred stockholders always get paid first. But in this case, in addition to getting paid $40,000 for 2024, we're also going to pay those dividends in arrears, because since no dividend was declared in 2023, we owe the preferred stockholders $40,000 for 2023 and $40,000 for 2024. Okay, so that's the key with cumulative preferred stock, is that you get paid those dividends in arrears if there's any year when a company misses the dividend. So $80,000 goes to the preferred stockholders. Always, when a dividend is declared as a total amount rather than telling you a per share amount, preferred stockholders always get paid first at their set rate. And so in this case, $80,000 goes to the preferred stockholders. Whatever is left of any dividend goes to the common stockholders. So if 280 was the total dividend, and we just said that the first 80,000 we're paying to the preferred stockholders, that means there's 200,000 left for the common stockholders. Any questions at all about dividends when we're splitting it between preferred stock and common stock? All right. Well, then one last thing. As we think about that stockholders' equity section of the balance sheet is, what does the stockholders' equity section of the balance sheet actually look like? Because it's, again, a little more involved than what we've done up to this point when doing a balance sheet. Because now, instead of common stock and retained earnings, we've added all these extra equity accounts that we hadn't seen before. Now, on a multiple choice test, obviously you're not going to prepare a nice, lovely stockholders equity section, but you could be given something like this, a listing of accounts or a listing of equity accounts and their balances, and you may be asked, what is total stockholders equity? The biggest key to remember there is that treasury stock is a contra equity account. Remember that that means that treasury stock decreases your total equity. All these other things, common stock, preferred stock, additional paid-in capital, those are all parts of that contributed capital section of our balance sheet. Retained earnings, remember that retained earnings is just the ending retained earnings from our retained earnings statement. All those things we just add up. The one thing we have to remember is that the treasury stock we always have to subtract, because treasury stock decreases our total equity because it is a contra equity account. So, like I said, that's a fairly comprehensive look at the problem type things from Chapter 11. The journal entries for issuing stock, treasury stock, declaring dividends, being able to split a dividend between common stock and preferred stock, and then again, being able to calculate what is total stockholders' equity on the balance sheet. But as I've mentioned several times, and I'm going to say it one more just to reinforce the idea, don't forget the concepts. Make sure you use your study topics and your notes from class and your textbook and the smart book assignments for practice, anything you can to make sure you don't forget to focus on the concepts as well as the problems. Okay, so that's chapters 10 and 11. Before we officially call it a day, does anybody have any questions on anything at all from any chapter? Doesn't have to be just 10 and 11, but anything you want to make sure we talk about before you head out today.
On the exam review,
Uh-huh.
I think it was, chapter 2, it said understand a general journal ledger posting trial balance.
Okay.
Could you explain?
Absolutely. Thinking back to chapter 2, when we first started looking at the accounting cycle. Remember, we started looking at the steps in that accounting cycle. That's actually a great thing. So review here real quick. So let's think about it. Remember, looking at the accounting cycle, that we start with the journal. Okay, the journal is that first step in the accounting cycle. Remember, the journal is where you get that individual transaction detail. So doing the journal entry is the first place that stuff gets into our accounting system. From the journal, remember, we post to the ledger. Okay, where the ledger is where we get our individual account detail. Okay, so the journal was super important because getting that journal entry into the accounting system correctly leads to everything else going like it's supposed to. So we put those things in the journal, we post them to the ledger. Then the next thing is that unadjusted trial balance. Okay, so that first trial balance, remember, is where we see for the first time a listing of all of our accounts with their debit or credit balances. Okay, as we think back as well, again, not quite part of this question, but just reviewing important stuff, we think about where things go on that trial balance. Remember that assets, expenses, and dividends all have normal debit balances. So any asset, expense, or dividend accounts will all have debit balances on any of the trial balances we prepare. Liability, equity, and revenue accounts will all have credit balances on any trial balance. Okay, because liability, equity, and revenue accounts all increase with credits. Okay, so you want to know which accounts increase with debits, which accounts increase with credits. But again, thinking about that accounting cycle, we did the journal, we posted to the ledger, we prepared an adjusted trial balance. Remember, after that, that's when we did adjusting entries. I mentioned earlier today, adjusting entries are those things that are necessary whenever we have revenues or expenses that cover multiple accounting periods. Remember that the adjusting entries are going to make sure our financial statements include all of the revenue we've earned and all of the expenses incurred. So those adjusting entries will always include an income statement account and a balance sheet account. Remember that adjusting entries will never include cash, because the whole point of an adjusting entry is that the revenue or expense is happening at a different time than when the cash is received or paid. So we do our adjusting entries. Then we prepare our adjusted trial balance. And again, any trial balance is simply a listing of accounts with their debit or credit balances. Just the adjusted trial balance has anything that we adjusted in the process of doing those adjusting entries. Okay. Finally, at that point, we can do our financial statements. Because remember, since day one, we've talked about that the financial statements are the ultimate goal of the financial accounting process, because that's what we're going to be providing to those investors and creditors and other people outside our business that want to know what's going on. So we think about those financial statements. Remember, we do the income statement first. Okay, the income statement, we take revenues minus expenses to get us to our net income. After the income statement, is a statement of retained earnings. Well, that one, remember, we took beginning retained earnings plus net income minus dividends get us to ending retained earnings. Then we did the balance sheet. Remember, the balance sheet looks like the accounting equation. The idea that our assets have to equal our liabilities plus our stockholders' equity. So we said that every account has a specific financial statement that it belongs to. Revenues and expenses go on the income statement. Dividends go on the retained earnings statement. Assets, liabilities, and equity accounts go on the balance sheet. Okay, so we do those financial statements. After financial statements, we got to close. Okay, remember, after the financial statements are done, closing entries are done, where we're going to zero out our temporary accounts. Our temporary accounts being revenue, expense, and dividends. Okay, because remember, those were things from the income statement and the retained earnings statement. Remember that those statements only presented the information for a specific period of time. If it's only for a specific period of time, at the end of that period of time, we got to zero those accounts out to start them over for the new year. So then the very last step in that accounting cycle is one more trial balance. And remember that that post-closing trial balance includes only our permanent accounts. So remember, the permanent accounts are those balance sheet accounts: assets, liabilities, and equity. So all that temporary stuff's now zero. So the post-closing trial balance is the official end of the accounting cycle. And then we start over in a new year. So for the final, we don't need to know like tons and tons of detail about all those things, but it is good to think back about all the different processes that got us from beginning to end of the accounting process. Okay, so again, the basics of those different steps, not a bad thing to understand. So I went a little beyond your question about just those first few things, but that takes us through a whole lot of stuff from chapters 2 through 4. That's really almost 1 through 4. That's kind of the gist of most everything that happened there. Other questions before we call it a day? And these solutions are also posted up on Canvas too, so you can always go back and get those there as well. Because especially like on this one, I know it's a lot to write if you're trying to write out a nice one, but solutions are posted, so you can go review those all you want to. Anything else? All right, cool. Promise I won't keep you more than an hour. So, there we have it. I wish you all good luck on the final exam and hope you have a great Thanksgiving.